A business can do $1 million and still be a bad month away from bankruptcy. I don't know if you've heard this before, but this is the reality that a lot of businesses, because they're not being run properly, actually go through. Right, Carla?
That's right. And that's one of the sad things that we actually see in our business. And I do feel bad for those business owners that have to face that reality, but it's definitely part of what we do.
Yes. Today we wanted to make this video together because, as Carla just mentioned, it's a sad reality and it's something that we hate seeing, right? As CPAs and accounting professionals, it's just heartbreaking to see how some businesses have a good idea, have liquidity that they could get, they have all these things going for them, and it's just one thing that usually trips them. And worst case, then we should be talking about how they should be scaling and how they should be now, thinking about getting new equipment, investing in the business, expanding, all of these things, but we're actually talking about bankruptcy, right? We've seen it in businesses over and over again, and we don't want to see that, right? And so today we want to talk about, some of these things that we've seen, right, in our experiences working CPAs with many businesses that have gone through this very problem, right? And it usually comes down to a couple of key things, right? That if we kind of are able to tackle those, usually that, at least for those that have liquidity, that have good ideas, that are businesses that are, their owners like have invested in it, have the right people around them, but for some reason, they're not at the level that they should be.
And in summary, the first thing that we see in these situations is bad management.
Yes.
By the business owners.
Yes. Unfortunately, that's the reality. I think, with that, bad management can mean a lot of things, but the main idea here is that what we see is, when some owners or managers do not put the right resources on the operations. Maybe they put some, the right moves and the right resources on the operation, but not on the finance, right? Not on the accounting. They don't put the right protocols and the right controls around how they operate the business, how they invest, how they finance, how they account for everything. And usually that is the mother of all the problems, right?
Right. A lot of business owners that we speak with, they think they can do the accounting themselves. And that, to me, is a really bad mistake. Because for us as accounting professionals, we went to school, we have the experience, we have the expertise, but you necessarily as a business owner, you don't know, and you don't have to know you don't have to really know how to do the accounting. You need to have the basic knowledge in order to be able to make a lot of the decisions. But the actual work as business owners, really, you shouldn't be doing your own accounting.
Absolutely. And we'll get into more details about how that works exactly. But basically, the introduction here is, we've been in this business for for a long time, 15 years plus. I don't want to call out my age, but it's been a long time we've been doing this, and we found that it was important to share some of these stories and some of the trips that we've seen. Hopefully that we can share that experience and we can maybe help some businesses avoid this to happen, right? So let's get to it, right? So the biggest misconception in business, right? So most entrepreneurs, we focus on revenues. Right, it's just what money comes in. How do we get money? Like, what do we need to do so that we kind of put that bank account to those digits that we want to see, right? And that's fine, right? That's the right attitude, but that there has to be some control around that, right? There has to be a strategy, and while one side of the business while the owners are focused on that, and if that is the majority of your time that you're spending on that side of the business, naturally you're kind of gonna either let go or not focus on the accounting side,
Right.
or hire somebody to do it, right? But what we see in a lot of these businesses where the issues happen, when we're talking about Bankrupt, is they put sometimes neither, right? They neither have the time to do it themselves, and then they don't find it important enough to hire somebody.
Exactly.
So what happens? It's just in limbo there, right?
Right.
It's just guesswork. And it's coming to tax time. There's crumbling around, trying to figure out what happened, where did the money go? How come they have all these taxes due? I don't have the money.
Right.
How many times have we seen that, right?
Yes, they don't know how to read the numbers necessarily, or know. We see in some of our clients that they don't know really where the numbers are coming from. They see this much, or maybe a high revenue, but they don't see the cash. So there's different things like that, because you have to understand the difference between what's actually revenue, invoicing, versus what's actually collecting, depositing. And there's a lot of different, I don't want to get too technical, but that's the first thing. Revenue doesn't mean necessarily that that's how much cash you really have in your bank account.
Absolutely. And I think that kind of goes along with the kind of the education that it comes to accounting, right? I think, a lot of us, when we talking about business and, even when we consider setting up a business, usually the accounting is just sort of like an afterthought, right?
Right.
It's like, it's almost like a box we need to check, or maybe optional, right? But the reality is, when you have the right accounting, or why it's important to have it correct, is because when you're gonna make all these decisions, having a clean set of books is just gonna make, that side of the business, that be the foundation to a lot of the decisions that you make, right?
Exactly.
Is it time to buy new equipment? Do I need to put money away for taxes? Do I pay estimates?
Right.
Do I hire somebody? Am I paying too much on certain parts of the business? Or sadly, what we've seen even happen is somebody taking money where they shouldn't be.
Yeah.
Right?
Yeah.
Is money misappropriated? Is it misallocated? Is someone, is somebody having a card that they're not supposed to? All of these things happen when you have clean books and when you have an accounting system, and it doesn't have to be a perfect, right? You don't have to throw all your resources into that, but that you match what your business has to that, to that side.
Exactly.
So yeah, and like Carla said, it's revenue is one thing, profit is another thing, and then cash is another entirely different thing, right? And all those three things are the main things in accounting, right? It's the most important. It's basically how we set up the accounting system, and it's what's going to drive all these decisions. So if you have the right accountant, then when you meet with them, right, on a quarterly, on a monthly basis, whatever it needs to be, those are going to be your three main topics of discussions. Okay. And so let's focus now on the 5 reasons why a profitable business, or let's just say a business making $1 million, why would they go broke? Okay. So high level. Okay. When you're growing, right, and this happens, right, this is basically, it's almost like it's a good thing. It's one of those that it could be a good thing, but depending on what your approach is, it could potentially be your downfall, right? Which is growth, right? So as a business owner, the one thing you want to see, which basically sometimes motivates you, is to see growth, right? When let's say you do a comparison from this year to the prior year, and you're like, I'm making improvements. it's like there's some fruit to my labor. Like there's a reason why I'm waking up at 4 in the morning and doing all these sacrifices.
I must be doing something right.
Exactly. I'm not just wasting my time, right? But with growth, there comes responsibility, right?
Exactly.
The worst thing I find that a business owner can do is to, as they're growing, that they continue doing the same things that they were doing when they didn't have the growth.
Right. They don't plan ahead.
Exactly.
Right?
Right.
They just see the numbers growing, but they don't see the different impact that growth will have later on.
Absolutely.
And that can only be done through planning.
Yes. Yes. Yeah. And it's basically the way that we find it is that like a business is like having a kid, right? As they grow, you need to adjust, right? How you raise your kids. You know, a baby, you can't put a teenager on a baby's clothing, right? That you need to adjust your approach and how you kind of nurture and growth and adjust the business to the reality, right? So what are some of the things that growth brings, right? Usually it's more payroll, right? Because you need to, in part of growth, you need to kind of put the resources so that you can offer, the business that you want, right? Usually more inventory.
Exactly.
Right? And more inventory, more problems usually, right? It's not a bad thing to have inventory, and growing inventory is a right target, but it has to come with management, right?
Yes.
More marketing. Right? Usually when that's the one thing that like when you're growing, when you're starting, that's the one thing that you feel like you lack. Oh man, if I was only able to advertise more, I think I can get to more people, right? Now as you grow, then you have those resources, then you can invest more into that, right?
Exactly.
And then more operating costs, right? Those are usually kind of like the growth, the one of some of the main things that happen, right?
Right. Because with the growth in revenue equals also growth in expenses.
Right.
Right. For everything that you just
Exactly.
mentioned,
Right.
you need more people. You need to hire more people, so you will have more in payroll, inventory. Like Julian just what he just said. All of those items will grow as part of your revenue growth. You just need to make sure that they both grow accordingly.
Exactly. Yeah. Because that's the main thing we see, right?
Right.
The growth comes. They have all these things happening, but they just do it blindly. They do it blindly, right? Meaning.
Right.
They don't know. They think, oh, I may need to hire 3 people. I may need to hire 5 people, but that's just coming out of your head, right?
Exactly.
It's just making it up, rather than just seeing what the actual numbers are, where your resources come from, where you're actually projecting in terms of revenue and expenses, and then kind of putting a more realistic number to those needs, right?
Exactly.
And that's basically how it works. So now let's talk a little bit about what are some of the biggest misconceptions in businesses, okay? Because this is kind of now we want to kind of focus a little bit towards more like what are some of the thought processes that kind of leads us into that bad path, right? While most businesses focus on revenue, the one thing where they kind of where they miss is cash flow, right? So what keeps the business alive is cash flow, right? Let me just give you an example. Let's say you have, we pick on realtors a lot. So let's pick on realtors for this example. Let's say that you, up through October, you haven't made one sale, right? But then in November, all of your listings are sold. This is not very realistic because usually those are more spread throughout. But just to give you an example, because there are some seasonal industries, right? But just to kind of bring the point home about, cash management. Is let's say this realtor, for whatever reason, it was only in the last quarter that had all their listings sold. So in terms of revenue, they probably generated good revenue, right? But what happened with the cash flow? Throughout most of the year, they had no money coming in. It was only through the last few months
Right.
that cash came in, right? So if that person didn't plan, what happened all those months that they didn't have the cash, right?
Exactly.
So, that's the biggest difference between, what revenue is and cash flow.
Exactly.
Right? Because we gotta pay the bills. Unfortunately, we can't call AT&T and say, hey, keep
Right.
my phone on, but I'm gonna get paid in October. So I'll pay you when I get
In
paid.
October.
Yeah.
Yeah, so exactly. The cash needs to keep flowing because your expenses will not stop because you haven't had the revenue or have received payments yet. So you have to make sure that you plan ahead to make sure you have enough cash to cover all of those operating costs until you actually do get paid. A lot of our clients, and I see it, they maybe focus on the profit and loss. That's the first thing they focus on. Maybe the balance sheet, but they never ask about a cash flow, which
Never,
is
exactly.
the one report
Yeah.
that will give you that information.
Absolutely. And how many clients do we have that when we sit down with them and we go over the numbers, they're surprised, right?
Yeah.
And what is the common denominator between those that are most surprised is that they don't review this enough, right? And that they don't put the right resources into this, right? And that's when you're having those tough conversations but at that time, you're just catching up, right?
Exactly.
So it's very frustrating, I would say for them, but also for us, right? Because then we're just playing this game where it's like, so let's figure out what happened, what is the cause of this issue, and hopefully the goal here is to know what happened so that they make corrections in the future.
Yeah.
Unfortunately, we've even seen, cases where we figure out the problem, but it was only so that they repeat themselves.
Right. Or it's too late.
Or it's too late.
Too late.
Right.
It's too late to kind of go back and try to fix it or put a Band-Aid, or that's when they get to bankruptcy, right?
Right. Yeah, and then we get the question, oh, what happened? Where did this go? It's like, yeah, if we met regularly, I wish I could tell you.
Exactly.
Right? So, those are the type of things, kind of conversations that go along. And it's for us, right? It's not that we're here trying to sell, let's say, I want to meet with you once a month because I want to get, because I want to get money out of you. It's to the benefit of our clients, right? That we meet with the regularity that the business requires, right? Because let's just also be honest here. Like, not all businesses require that much attention, right? Some business require, let's say, to the one side of the spectrum is, they need constant monitoring, right? They have inventory, they have high payroll, high inventory. They need to ride on the money, they almost daily. They need to kind of work with their cash flow, right?
Exactly.
There's some businesses that are not that type. They're more service, service focused, like lawyer, a doctor,
Right.
Someone that provides pool services, landscaping, although landscaping also switches over a little bit more to the to the hard part, right? But those other businesses may not require that much attention.
Exactly.
Right? So you can put at least quarterly, right? It doesn't hurt you to meet with your CPA or even your tax preparer.
Right.
Although that sometimes because tax preparation, that's all it is.
Right.
Unfortunately, right?
Yeah, and we tell our clients also all the time, you have to be proactive and not reactive. If you're being reactive, it's too late by that time. There's no really a plan or different items. It might be too late to implement some of the strategies. So definitely meet with your accountant regularly. But going back to the example of the realtor, when you know that you are going to need the cash flow because the example that you gave, you're not going to close on that home and get paid until a little bit later, how much debt can you actually put in the business before you put too much debt? So if you get a loan from a bank, if you get a line of credit from a bank to be able to maintain yourself throughout those months until you actually receive those payments. But if you get in too much debt, that's a problem as well.
Yes.
And so if you don't plan ahead with a professional, that, believe me, it's gonna happen.
Yeah. And we see a lot of kind of that accountability issue, right? When, let's say you're a business owner and you have no one to answer to, and you're just kind of making all these decisions.
Right.
It's almost like a spiral out of control, right? It's just like a vicious cycle where it's like, well, you know, you don't have the clean books to make the right decisions.
Right.
And then not only that, but you have no one to answer to, so you just kind of pick ideas out of the hat, right? Just like you're just kind of going with the flow, whatever, you know, idea you might have, and you have no one to just kind of maybe sit down and discuss, you know, is this a good idea? Do I have all the alternatives? Is this the right time to do this? So there's that accountability part that is important too. And when you said debt is also another one, right? You know, if you don't have, like, let's say, some internal controls to either, let's say, draw on a line of credit or get a business loan or something like that, and you just do it whenever you want.
Right.
Then you kind of have that temptation to just kind of like just out of the hat, just go ahead and do it. Right?
But exactly, but you have to know that you have to pay interest on that. You have to still make payments on the line of credit or the loan. So you have to know the cash flow.
Yeah, and then also, like, you make sure that you put that money to good use, right? Because you do not, like, the right strategy is you get the loan or the debt is to generate more business, right? If you're using that, then it's all for it, right? But if you're just doing that and you're not using it correctly, you know, can you even afford it, right? So very, very important point. So let's talk, Carla, about the 7 reasons why a 7-figure business would go broke, right? Let's focus on, like, when you and I discuss this, let's focus on 7, right?
Okay.
So number 1 is growth without cash, right? So just basically a little bit more of what we just discussed, right? That's when you're heavily focused on revenue and you're not focused on cash.
Exactly.
Right? That's number 1, right? As we mentioned, there's all these other things that come with the growth, right? The marketing, the payroll, just you know, operating expenses. Maybe you're looking into going into a bigger office. All of these things require planning. But to us, it's the number 1, right? Growth without cash.
Yeah.
So number 2, weak margins. Yeah. So
a lot of people, we tell them and we speak about margins, and they have never heard of it.
Yes.
And it's something that every business owner needs to know.
Yeah.
What the margin is and what does it mean and how does it affect my business.
Absolutely. And it doesn't mean so. Having low or high margins doesn't mean that a business is good or is bad, right? Some good businesses have low margins and some bad businesses have high margins. So normally you want higher margins, that's true. That's generally the higher the margins, the more that the better the business look, you know, the outlook and the perspective to generate more money, right? But there are some low margin revenues where there is the quantity, right? That if you sell enough, those low margins accumulate, you know, to that. But the important thing here is that you know where you stand.
Exactly.
Right? Because whether it's a high margin business or a low margin business is going to dictate how you're going to operate some things.
Exactly.
Right? And then it all comes back to cash, right? You know, in the low margin example, you know, like if you're operating in low margin, then you need quantity. You kind of have to be on the lookout that you have enough quantity to meet your obligations, right? And then in the high margins, let's say those that don't happen too often, the good example is the realtor. If you have high margins, but they don't happen so regularly, then you have to plan the cash for those periods where you don't have any, right?
Exactly.
So $1 million in sales means nothing if margins are thin.
Exactly. Yeah, and it's different in different industries, like you said, but it's definitely a conversation that you have to have and understand.
Absolutely.
With your accounting professional.
Absolutely. And the one that I think you like most, Carla, is too much debt. Right?
No, I don't like it.
Right. It's the one area that I feel like Carla is very strict,
Yes,
right?
I am.
Debt. And rightly so, right? Debt, I think it's one of the, biggest issues, especially here in America with so many access to debt.
Exactly.
It's so easy to fall in so many traps, right? Now, debt, it's just like a lot of things, right? If you use it correctly, it's actually going to help you.
Exactly.
It maybe even be a lifesaver, at certain moments.
Right.
But if you don't use it right, it can actually be what drowns you.
Exactly.
Right.
Exactly.
So so when we talk about debt, is the utilization of debt, not debt itself.
Exactly.
Right?
You just have to make sure that you use it correctly and to your advantage.
Yes, exactly, exactly. What we just mentioned earlier, right? Is what are you going to use that debt for? Are you going to buy more equipment? Are you just getting credit cards to pay personal stuff?
Right.
Are you just expanding loans for personal use, or are you actually expanding the business?
Exactly.
Those are the decisions that are gonna either make it or break it when it comes to the debt, right?
Exactly.
So number 4 is poor financial visibility, right? I feel like as I go down the list, I feel like the first couple were more important, but I think these are all very important. They don't really go in that particular order.
Yeah.
But yeah, poor visibility, I think it's up there in terms of.
One of the things that we learned in college, right, when we started studying accounting, I did at least, one of the things they say is numbers don't lie. And that's true. Numbers do not lie, but you have to make sure that those numbers are correct.
Absolutely.
Because if the numbers are not correct, then yes, your numbers are lying.
Right. Yeah, exactly. Yeah.
So that's why you have to make sure that you have clean and correct financial statements prepared.
Absolutely. You could not say it better. Do you trust, if you trust those, if you trust your numbers, then your decisions are going to be based on the right information.
Exactly.
Right?
On the correct information.
It's just so frustrating at times that we see it with some of our clients where, you and I don't have confidence in what we're seeing.
Exactly.
And then if you don't have that, then for us to give an advice. So what we don't want to fall into the trap is giving advice based on the wrong decision, based on the wrong information.
Right.
Right.
Yeah.
So the best case scenario, or what you want, is have the right foundation, and all these decisions are just gonna be easier, better, more efficient.
You're gonna feel confident about your decision.
Absolutely, absolutely, and we see it even in our clients, right?
Right.
When our clients that have that invest, and it's not just money. Sometimes it's just investing time on this. You can see just exactly what you said, how much confident they are, different than those that are that they don't know what a profit and loss is, that they don't they don't trust what they're seeing. They don't even know or are able to figure out how those numbers came about.
Right.
You can sense it, right? Just the frustration and the anxiety that comes, with. And obviously for us, what we're not saying here is that you should all of a sudden become an experienced and expert accountant in your business, right? It's just that if you naturally are not going to have the time to spend on figure all this out, it's just hire the right resources. Exactly. Right? And what you said at the beginning is the key. It's a proactive.
Right.
That's the other thing. It's not just, there's even some alternatives that you can find even on that, right? Because, some accountants will focus more on, let's just, give me I'll just categorize, and it is what it is.
Yeah.
They'll just present you with a spreadsheet and just be like, have fun, right? While there's the proactive, right? That is, let's just get to really what this is. I'll share with you my comments, what you were seeing. This is where this is going. This is what's going to happen. This is how we can protect. This is how we can react.
And then ourselves as tax professionals, we want to make sure that we give you the right strategies, right? To implement, to give you the right strategies, we have to be confident on the numbers that you're providing to us, because otherwise we could give you the wrong strategy.
Exactly.
So obviously we don't want to do that, and we don't do that. We do check the numbers first to make sure everything is correct. But if we are going to be able, in order for us to be able to help you with those strategies, those numbers have to be in line.
Yeah. They don't have to necessarily be 100% perfect, right? But let's say above 80, just to be charitable, right? Because we're not seeking perfection here.
Right.
We're just seeking common sense.
Exactly.
Right. Yeah. So the next one is weak margins, right? And by the way, I'm not saying low margins or high margin. I'm saying weak margins, right? So these are the examples where your gains do not match your expenses, right? You're just basically working to be flat, right? And why this is important is because, it could be an issue that is not even a business issue, right? It could be that you have too many expenses, or you're not operating the business correctly to match what the revenue is. One example could be, maybe you have a penthouse office when your business can easily run on a shared space, type of office environment, right? So nothing against that you're able to afford that penthouse office,
corner office
like you and I want, but it has to match the the revenue, the cash flow, and the business that you're in.
Right. Is having that corner office really going to help me sell more?
Can I afford it? Can I even afford it? Right.
Is it going to help my revenue?
Exactly. So it's those are the type of, that's kind of where we go in this margin scenario. So the next one is, so we talked about too much debt, we talked about visibility. Now, that's when you and I come in, right? Having the strategic financial advisor, right?
Exactly.
What we kind of learned throughout the years is where maybe we started the business as counting CPAs.
Right.
We've more evolved into more like a financial type of, advisory that we offer, right? And to be clear, we're not saying that we're financial advisors, that we have the financial advising certificates, but in this side of the advisory, which is the accounting, the point here is we're not just your debits and credits accounting that you're traditionally think of, right?
Exactly.
We're very strategic in that, what we're looking for is for your financial benefit, right?
Exactly.
It's, you gain nothing from just hire traditional accountants that would use the debits and credit, and you're no better than where you were before, because you have no idea what this is, what this is or what it does, right? So what we focused the last couple of years, especially, is on just the zeroing in on that advisory part, right? On like talking with our clients more often, meeting with our clients more often, insisting on it even when we can. Right, because we know people are busy. There's people. Business owners may not have the freedom to meet on a regular basis, but but we but we even try to make it easier, right? We offer Zoom meetings when needed, Teams. We can jump on a phone call. Exactly. We have our client portal where you have a quick question, you can just send a chat.
Right.
So we try to be accessible.
Right. And one of the things that we find during these meetings is a lot of times the client, because they are going on their day-to-day business, there might be something important that they forget to tell us, right? Throughout something, maybe they purchased a big machinery or a home or whatever the case may be, and they forget to tell us.
Right.
And during these in-person meetings or virtual meetings that we have with our clients regularly, those topics come up during the meeting as we're having a conversation.
Right.
So we could be having just a normal conversation with our clients about their business, and then suddenly they remember, oh, I forgot, I purchased this new car.
Right. Or that we actually fulfill the proactive part and say, I'm considering buying this equipment. And then it's like, okay, let's see.
Let's analyze.
Let's analyze. Can you afford this? Right? Is it the right timing?
Exactly.
I know that you might think you need it or you might think you want it. Maybe after we kind of have that sit down to figure out where you're at, it might not be the case. Right? But that is exactly why you meet regularly. Because if you show up in March and April and you say, well, it turns out I bought that new car last year.
Right.
And it's like, okay, well, yeah. I mean, now all we can do is just fight it, right?
It is what it is.
It is what it is. Exactly. So yeah, the decisions. This is what we always talk to our clients, right? The decisions are not made during the year, are not made during tax season. That really comes down to the decision of filing. The decisions are made throughout the year, right? Yeah. So now I want to talk about the warnings, right? Some of those warning signs that we've seen, some of those red flags popping out, and why some of these businesses fall into this, problem, right? So let's just kind of run through a few scenarios that we feel are just kind of highlight some of these warnings, right? A business that is always waiting on receivables, right?
I love financial statements.
Yes.
One of the first thing that I look at when a client provides us their financial statements, one of the first lines that I look at is their accounts receivable, and I look at the aging.
Aging, yes.
Yes. I don't know that all business owners do that or pay that much attention into that. And if you're not, you should be.
Yeah, and this is not the situation where you age like a fine wine, right? It's not. This case is the opposite, right? The more that a receivable is just really sitting out there, the less chances of collection, right?
Exactly.
And it's just a problem overall. It reduces your profitability, even if, let's say, you want to sell the business, right? One thing that they're going to see, same like you, is how long are these guys waiting to collect, right?
Right. And you might be counting on that cash for something else. You might be counting on that payment that you think you're going to get because you're waiting to invest on something or whatever the case may be. So you're counting with money that you don't know if you're actually even going to get.
That's right. Next one, payroll stress.
Yes.
Right? And let's not talk about some of the misusage of payroll things, misallocation of funds.
Yeah.
But payroll stress, it's another bad sign, right? If you're scrambling around to figure out how to pay, your employees should be, you should have enough there for even a couple months reserves to cover payroll.
Right. I mean, payroll stress is definitely a red flag.
Yes.
That something's not good. It's going on.
Yeah. I think it's one of the biggest warnings in a business.
Right.
And also, it's one that the IRS doesn't mess with, right? We've seen it even more recently, just how the IRS, they're even so particular about, that they're filing the right forms.
Right.
They got away from taking manual 940 and 941 forms. Now they want all these things electronically. They want you to pay electronically. So they're really kind of just honing down on payroll.
Yep.
Credit cards covering operations, right? So, and I don't want to kind of, mislead here in that we use credit cards to cover our operations.
Right.
But it's actually when you don't have enough, when you're going over your limit, and when you don't pay your credit cards, right? Where you're just mounting debt, you're actually getting new credit cards to pay
the other credit
cards.
cards.
That's when we start seeing some issues, right? If you're regularly able to use your credit cards for the operations and then you pay them regularly, you don't necessarily have to pay everything. Hopefully that's the case, right? You have enough cash to pay the whole thing.
Right.
You may be on a seasonal situation where, maybe you just kind of leave some balance there for a few months, and then once maybe some revenue comes in, you pay it all off. But the point is not to snowball that into like a bigger problem, right?
Exactly.
Tax payments becoming emergencies, right? Big one. It's almost like that double punch, right? Because like if you're in a business that is having IRS problems or tax issues, it's not only the fact that you're not paying your taxes and you're not able to cover that, but that you also have the IRS on top of you, right? And it's just such a bad situation that brings so much stress, so much anxiety.
Right.
It's really hard to operate around that, right? It almost feels like some of the business owners that we worked with who had that situations almost feel like it's such a like block in the road, that it's almost like they can't get past, figure until that whole problem is figured out. They can't get past that. It's almost like for me to be able to move on, I need to get rid of this problem, and it's so. It's just, it collapses, right? Almost the person, right? It's just, it creates a stop, like a break on the, as a person, on the business. It's no good, right? So owners draws without planning.
Yes.
Big one, right? And this comes back to that whole thing with accountability, right? Having internal controls. So, for example, if you have an S corp, it's perfectly, allowed that you have a reasonable salary, and then you do a mix of salary and distributions, right? But it goes back to planning, right? It has to be analyzed. It has to be addressed. It needs to be, if you have a business partner like I do, it needs to be a dual decision, right? It has to be.
There needs to be a conversation. About it.
Correct. So you're doing your business no good if you're just randomly picking, taking money out, and then coming back to the whole reactive is then a year later you're trying to figure out where that what happened here. So yeah, big warning sign. So this is a big one too, and it's and
it's very common.
It's common more than than you would think, or that it's necessarily healthy, but it's the reality, right? And it's having one large client that dominates the majority of your revenue, right? And this is especially true as you're rising, right? Because as you're rising, kind of like what you're trying to see is just to catch some breaks, right? Hey, I was able to get this client, I was able to get that other one, but those are kind of those becomes your building blocks, right? So obviously, as you're building blocks, there's less blocks to build from. So it's common that you're going to have just fewer clients that dominate the revenue. Right. But your goal should always be to be able to just kind of grow the business so that you're not relying
on one. Because just think of what happens if you lose that one client.
Yes.
Imagine what that will do to your numbers.
Yeah. Then you're scrambling to figure out where you at. So I think high level, that's kind of like the warning signs, right? But now let's see, how do we avoid this, right? How healthy business would avoid all these issues, right? Cash flow visibility. There we go again, right? Kind of goes back to what we mentioned at the beginning. How do we, what are the right moves in this case, right? Just, if you're able to, we know that you're busy. We know that you're out there hustling. Try to take some time to look at your cash flow.
Definitely.
Yeah. And margin awareness, right? Exactly what we just described.
Right.
It does, whether it's high, low margins, just know what your business is and what it does.
Make sure you understand it and how it affects your decisions.
Debt discipline, right? What we just discussed. It's not that the debt is the issue, it's how you use it.
How you use it.
Right? Tax planning. That's where we come in.
That's our favorite.
Right? Definitely, it's kind of like an underrated area, right? We see it regularly. How much when you and I set up a tax plan, just to see in our clients' faces, it almost makes our day, right? It's like, oh, if I didn't know about the strategy. I didn't know if I put into retirement that this could happen. I didn't know that if I got into like a short-term rental, that I could, and if I could, how I could do like a proactive revenue. Not a passive, an active revenue. Especially, some couples married that, maybe one of the husband or wife, he has like, let's say, a W-2 business, while the other can, maybe it's more of a freelancer, and it's maybe so they're able to invest on a property that if they do it correctly. That when we take into depreciation and all the expenses of that property, that can actually get into minimize that W-2 income or reduce it. That W-2 tax, right? That tax liability, because there's a whole nother video for that, but it's just between the passive and active income, right? And how those two normally don't cross unless you do these strategies. Right? And when we see our clients, their reaction to how we can help them, it makes our day.
Exactly.
Right?
Yeah.
So tax planning for us has been just like, for us in our business, right? It has been an experience where like for us as, as consultant and as advisors, how we are able to help our clients during the tax planning has been a life-changing experience, right? And then CPA advisory that comes with the planning, right? Because there's one thing is to go do these plans, and then another one is to put them into implementation, and make sure that they work, make sure that we're doing the right things. It's not just okay, here's the plan, a magic bullet that is just going to solve everything, right? And, that comes with some work that
and that goes back to the being proactive.
Exactly, exactly. So I think, Carla, that's pretty much it. I think we can finalize this with what is our role as CPAs to get that financial stability, right? And what we do best, right? Financial statement review, right? And what we talked about, having the right numbers, the right financials.
That's the first thing we do.
Tax forecasting, right? Don't forget about paying Uncle Sam. Cash flow analysis, we spoke on that. Margin review, entity and compensation strategy, right? The whole reasonable compensation thing. Major purchase consultation. It's not like you need to ask me if you should, know that you need my approval, right? It's your business. Let's just talk about if it's the right time to do it and if you can afford it.
Right, it's a good question. It's a good question to ask.
Yes, yeah. It hurts, it doesn't hurt.
It doesn't hurt.
Right? You don't have to feel like, I need to ask permission from my accountant. He says, hey, I'm just going to talk about it to see if it makes sense to do it at this time.
Exactly.
So I think with this we can close. It's been a fun video for me, Carla. I hope it has been for you. And this is the type of education that we like to share here on these videos. So if you like this, please follow us, hit that like button, and we hope to see you again very, very soon.
Bye.
Bye.